Thank you, James, for that introduction, and thank you for all of you for being here today. Is there any chance we get those poll results back up on the screen? I just wanted to have a look at those before we kick off. So digital innovation, 40% seems to be the one that you think will have the most impact. We have plenty to get through today, and I do want to dive in quite quickly, but first of all, I just wanted to invite each of the guests on the panel to introduce themselves and briefly talk through their particular part of the market, just because we do have quite a diverse panel. Matt, I'll start with you.
Sure, and thanks, Chris. As James said, I run the WAM Leaders product, which was listed in 2016. We're an ASX 200 fund. We're at LIC, so we're on the ASX. We started around $400 million and now about $1.8 billion. And what you get with WAM Leaders is a highly active ASX 200 product. So every day we're trying to make new decisions, new information's coming, and we're trying to adjust the portfolio at all times. So that's what we do.
Thanks, Matt. Sergeant?
Yeah, good morning, everyone. Sergeant Dungabich, I'm one of the founders of 5V Capital. We're a private capital funds management business based here in Sydney, focused primarily on mid-market private equity. There's a team of 45 of us across here in Australia as well as New Zealand, looking at opportunities to partner with founders in really exciting high growth businesses. We roughly manage about $2.6 billion across 7 different funds. And one of those funds is a newly established sort of open-ended structure, which is one of the reasons for the conversations today, I think.
Thanks, Sergeant. James?
Thank you. So James Abella, I manage the global mid-cap fund called Global Future Leaders, which has recently gone into an ETF format, and also the Australian Future Leaders Fund, which is an Aussie mid and small cap fund. Global large caps is really 50 billion US and below, so $75 billion opportunities and below, whereas Aussie is around, mid caps around 15 billion Aussie and below. The key difference of the fund is really the blended style. It's called QMTV, so quality, momentum, transition, and value, and we try to have a blended approach with anchor points of weights for those, but try to keep it blended and therefore a smoother outcome for clients, which has been proven for both products over the decade.
Thanks, James. Andrew?
So I'm from Metrics Credit Partners. We manage close on $20 billion, primarily in private market debt. We have a range of different funds and vehicles for both wholesale, institutional investors, both domestically and offshore. We have a range of funds that are also available for private wealth and retail clients, including a couple of ASX listed funds that we operate, including the Metrics Master Income Trust, or MXT, and also the Metrics Income Opportunities Trust, which runs by the ticker of MOT. And actually we have a vehicle in market at the moment where we're undertaking an IPO called the Metrics Real Estate Multi-Strategy Fund, which will run by the ticker of MRE. And so that'll be our third ASX listed fund that we're about to launch.
Thanks, Andrew. All right, let's get right into it. The first seismic shift that we will discuss is economic regime change. So the last 2 years, as we all know, has seen volatility when it comes to interest rates and inflation. Central banks couldn't buy inflation for the decade before that, we mustn't forget. Then it arrived all too quickly, and now, like family members, when you host Christmas, that it doesn't want to leave. So Matthew, I'll come to you first. Where are we in the cycle, and how is it impacting your opportunity set?
Yeah, I mean, where are we in the cycle? A great question, and one that's caused mass confusion for the past 2 years. I think the amount of economists, strategists that have called recession over the last 2 years has probably been outweighing the bullish. So I think they're a little bit gun-shy now to call it recession, but like if you tick all the boxes, the probability of where we're going now, we are in the slowdown phase. We've had the uninversion of the yield curve, which is generally a sign of the next phase. The labour market is softening, particularly in the US. We're seeing signs of weakness there. The probability, though, is increasing that we go into this, let's call it a recession in the US. Again, it's a probability. So everyone thinks rate cuts are coming. So, obviously rate cuts are going to happen this week. Generally, they only work in one particular instance, and that's when the economy, the delta of the economy on the ISM is ticking up. We think that the delta of the ISMs is probably flat to negative. So we don't think rate cuts will save the equity market in the short term. So everyone was betting on 25, 50. We don't really care. We think the direction short term is quite negative. And again, it's very confusing, this cycle, because generally everything lines up. But this cycle has been quite unique where you get a lot of false indications. But if you tick all the boxes of the yield curve Labour market, the equity market generally rallies pretty hard into the last 6 months pre-recession. So the odds of a recession are increasing. Not saying it's going to happen, but the odds are increasing. So I think being cautious and defensive is worth being on that side. Credit spreads are incredibly tight. So there doesn't appear to be any signs in the hard data yet, but I mean, it can change very quickly. So we're just watching that at the moment.
Thanks, Matt. James, I'll come to you. Let's talk valuations. How is the changing price of money impacting valuations and the way you assess opportunities?
Yeah, it's been very significant. So what's happened in how we look at the world is quality and momentum has been really strong. So got earnings upgrades, multiple expansion, high investor confidence, and much longer duration. So that recession word has now gone out of our heads. We're into the everything bubble. And quality momentum has been a huge beneficiary. On the other side, you've got things that are capital intensive, labor intensive, financially intensive, like just very intensive for all of those things, which is really the worst part of inflation. So things that are in infrastructure, real estate, or most of energy has really been in this sort of bear market, and our resources are going to this bear market. So what you found is this bear market here and a bull market here. So what we've found is we're maximum overweight here because of the recession concerns, but now we're looking for a lot of these what we call the in-betweeners. And these in-betweeners sit between quality momentum and these value bearish sort of segments. So that can be consumer, industrial services, property services, industrial services, any kind of services business which is actually pretty stable, but it's not part of this kind of really hot quality momentum market and not part of the really cold, disinterested bear market in resources, energy, REITs, utes and infrastructure. So that's how we're sort of seeing opportunities that are kind of there and there. But yeah, that's sort of where the world has led to.
No doubt we'll unpack some of those opportunities shortly, James. Andrew, I wanted to come to you now. Regulation and cheap money really fueled the growth of private credit. Some are now saying that if inflation sticks around for longer, things might get more difficult. What's your assessment of the backdrop and how is it impacting your business?
Look, I think that's a little bit mistaken. I think regulatory change has obviously been a driver of private market demand in private credit. And that's primarily coming off the back of the global financial crisis. You know, if governments are going to provide a financial claims service and depositors are going to benefit from that, then I think the trade-off of that is that governments are going to want to reduce systemic risk. And so, you know, rightly or wrongly, the banks receive deposits. They get the benefit of government guarantees where things turn pear-shaped. And as a result of that, I think the regulator wants to reduce risk within the banking sector, and that's not just in Australia, that's globally. And so that has really driven the demand for, or the opportunity in private credit, and that's largely off the back of the ability to raise capital to then deploy sensibly into appropriate opportunities to drive a return for investors. So I think, you know, I look at it in two ways. At one end of the spectrum, private credit is delivering a very attractive return for the risk profile compared to alternative traditional fixed income opportunities where investors have really been skimmed by intermediaries, the banks, who are really driving down a return that's paid on those credit assets to be able to reward shareholders. At the other end of the spectrum, there's an opportunity to deploy capital because the banks are reducing their willingness to lend in certain sectors, and that's driven demand for credit away from the banks. And so you've got this situation where, you know, sensible lending done appropriately is delivering great outcomes for both investors, delivering good outcomes for companies, but it also supports economic growth and activity in the economy. So I think, you know, certainly from my perspective, I think there's a real role to play in private markets. You know, it's quite different, obviously, to the role of, say, a bond fund manager or an equities manager that might buy and sell in secondary markets over an exchange, as opposed to, you know, origination in primary transactions where you're delivering the capital to support economic activity.
Thanks, Andrew. Surgeon, private equity tends to slow down amid high rates and vice versa. If and when we do see rate cuts in Australia, are you expecting to see more opportunities?
I think the simple answer is yes. You know, increased availability of cheaper capital should drive more activity overall. But I'd say my own view is probably it's a little bit more nuanced than that. I think there's a big question mark as to why rates are going to be cut and what are the implications from a macro perspective around inflation, overall confidence in the economy and so on. And so I think it's probably we're at the stage now where the macro is impacting activity, I think, as much as rates, the rate levels themselves. Where it's probably most acute is at the large end of private equity. Putting aside Air Trunk, which we've all read about for the last few weeks and months, there haven't been a very large number of larger private equity transactions in the market in Australia for the last 18 months. And part of that is, the cost of funding. Part of it is maybe the availability of capital, albeit I'd argue it's been capital has been available for the right transactions. And so I think as the macro situation comes with more clarity, I think we're going to see a pickup in activity. The question for all of us, I guess, is when that plays out. Again, from a sort of a mid-market perspective, which is where we operate, we find that rates are probably less influential on the levels of activity. We're typically not using very high amounts of leverage in the investments that we're making, and so the availability of credit or the cost of that credit isn't the determinative factor. And so we've seen quite good continued activity in that mid-market, not just within 5V, but a number of peers that operate across Australia, New Zealand, and certainly if you look at the US and Europe, those levels of activity have been relatively strong. We're investing in businesses that have got good growth opportunities, so they're not isolated from the macro thematics, but they're not necessarily growing at a GDP plus rate. They've got great opportunities to gain market share, growth through M&A and the like. And so I think, the mid-market piece continues to be quite active. But I would, to come back to your question, from a large cap perspective, definitely see that playing into levels of activity if and when it happens.
We'll move on now to the next seismic shift. Nice segue there. It is public versus private markets. One of the biggest conversations that is going on in markets right now. We've just seen the Air Trunk deal, as you mentioned, Surgeon, $24 billion. Retail investors didn't get anywhere near it. Really highlights some of the concerns around access and where capital is flowing. Andrew, I wanted to come to you first. Metrics now manages around $20 billion. Private credit seems to be the flavour of the month. What I really want to know is where is capital flowing and where is the demand coming from?
So we're active across the market, and it's really the demand for private credit on the borrower side is really coming as a result of that withdrawal of availability of funding across the banks. And I guess that also includes, the investment banks that previously might have underwritten transactions and then distributed the debt to non-institutional or non-bank investors. But on the demand side, we continue to see very strong demand again as the banks pull back. And our market is quite different. Australia is a market where we don't have companies that have got external credit ratings. They don't have the ability to easily tap a bond market. Public markets don't cater to the flexibility that's required to finance certain investments. So undertaking CapEx or undertaking construction of a project or undertaking the development of a property requires some form of tailored financing that public market bond instruments don't really cater for. And so there's genuine demand from borrowers that are looking to access capital. And I guess having the availability of financing away from the banks gives borrowers choice, gives them diversification of financing, gives them the ability to have a differentiated capital structure. So again, if you think about the banks, they're heavily regulated, they're heavily leveraged, and as a result of that, they tend to skew their lending activity for large-scale corporate and institutional lending to more investment-grade counterparties. And they certainly don't have the capacity to do much beyond senior secured or senior unsecured investment-grade debt. So the ability to structure a transaction where you might be providing some form of senior debt, subordinated debt, a holdco instrument, some form of flexible financing arrangement is important in terms of being able to assist companies and projects to be able to appropriately raise capital to undertake their activity. And so, where I see it across our business, we continue to see very strong demand in real estate markets, and that's primarily, again, in residential and industrial development. Clearly, the market is slowing with interest rates rising, slowing general economic activity. But there's certainly a lot of pent-up demand that we see in residential markets. And so, again, it's a transition. If you think about Australia, we're going from a situation where, previously we would have been happy to have freestanding houses and of course, with the cost of infrastructure to build, road, rail, power, sewerage for new estates. It's expensive for governments to provide that level of infrastructure. And so again, you're seeing increased density around transport hubs. So again, that drives residential property development activity and demand that we're heavily involved in financing. So, across the market, it's a very large, significant market, and that I often say to people, we as at Metrics have around about $11 billion of commercial real estate debt exposure. That pales into insignificance against a market that's probably around $400 billion, or at $20 billion, we're a large private debt provider, but the market as a whole is probably around about $1.2 trillion. So, this is not an area where private lending is dominant. The banks continue to have a very dominant position in the market. But what private markets do bring is the ability to offer alternatives, and really what we sort of see is across a whole range of areas, be it infrastructure projects, be it real estate, be it corporate, be it acquisition financing. There's demand for credit, and that obviously drives the investment opportunity for investors in our funds.
Surgeon, when it comes to private equity, I think Aussies are still carrying the scars of the Dick Smith heist from 10 years ago. What's changed since then, and what are the benefits for investors?
I mean, it's slightly a tough spot here, but you'd hope. I think you'd hope that both sides, adapt and learn. I suppose there've been a number of private equity IPOs that have been successful. Equally, there have been a number that have been, spectacularly unsuccessful for lots of different reasons. And so, I think from a market perspective, as we think about our engagement with the ASX or listing opportunities in our portfolio, we're very conscious that for it to be done sustainably, and we're building a business that's going to be around for the next 20, 30 years, and hopefully we'll be accessing the markets over that period. We're very conscious that we want to be selling great performing businesses. And so an example that we were involved in was a business called Universal Store, Brisbane-based omni-channel retailer. We'd invested there with Brett Blundy, a phenomenal business, a great management team that's still largely in place. And that IPO took place in at the end of 2020, so just off the back of that sort of first round of COVID. And the business has performed phenomenally well since then. There's been ups and downs from a share price perspective. I think today it's roughly 2x the IPO price. But the business itself at an operational level is going very strongly. And so I think, from our perspective, we engage with the market. We engage with the market with a very, a long-dated approach in the hope that success is recognised the next time we go to market ourselves. You've also seen, GYG obviously has been in the press, and that structure was probably a bit more innovative, maybe accounting for some of the facts that, or the shareholder base where there are a number of private capital investors involved in that business, and the arrangements there around the way that IPO was executed, the way the shareholders were brought on board probably much earlier than in a typical IPO process, hopefully gives both sides a lot more confidence around the sustainability of that and the longevity of the success of that business. And I think it's, time will tell how that asset performs. I don't have any particular insights, but, at least from a process perspective and an approach perspective, I think it gives the best chance of success. So, I'd hope both sides learn over time and it evolves, and, there remains, from our perspective, a great opportunity to take companies public. But equally, we look at lots of other exit avenues, and probably, out of the sort of 8 or 9 exits that we've had across the portfolio, really only one of those has gone to a listing. Others have gone to other financial investors, international private equity funds or potentially strategic buyers. And so it's a consideration amongst many others, but it should be a good one and a viable one going forward.
James, I want to bring you in here. I know you operate primarily in public markets, but you held Apollo. We just heard from Scott for some time in your portfolio. What's your take on the changing balance between public and private, and where are you finding some opportunity?
Yeah, there's a massive opportunity, as has been spoken here, in private markets, just absolutely enormous. So we've held Apollo and also Ares, those two ARES, Ares. Both of them have had basically doubling in earnings, doubling in share price, obviously, doubling in sales over the last 5 years. So that compound growth rate of 10 to 15% has just been bang, 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 bang every year. So And we don't all the recent videos and both of them have said it's just a structural growth trend. It's there as has been talked about. So we're very bullish on them. We looked at also KKR, Carlyle. They're in our universe as well as Partners Group. So those big five are all in our world. But obviously KKR is now 100 billion. Ares is 60 billion. Apollo's now over 50 billion as well. So they've been just great companies to own, but now they're obviously big. But yeah, just enormous opportunity. Structural growth is phenomenal for those.
Matt, I don't want this to become a private markets love-in. There's a big, beautiful ASX that still exists that we can all participate in. Where are you finding some opportunities at the moment?
Well, it's pretty hard, to be honest. We've been massively underweight the banks and still believe it's the right call, but it's been spectacularly wrong. We just can't get our heads around the share prices. But where is there value in the ASX? I mean, we sit on the defensive side, so we're looking for defensive sectors, defensive companies, things like Telstra, which have been sort of left behind. Everyone thought Telstra was a very boring company. It was in decline. It's actually growing again now. The data world has moved back towards them. They do have all these subsea cables. They're building intercity fibre, a huge rollout. So they're going to get a return on those assets. So we think Telstra looks really good. And another one across the ditch in New Zealand is Spark Infrastructure. Again, very much similar. Telco is almost a non-discretionary item now. People can't live without the internet and mobile. So we think these companies are being massively left behind on a relative basis. And then things like healthcare look good to us as well. There's a few opportunities in healthcare. CSL, obviously a bit of selling pressure in the short term, but sub 300, that looks interesting to us. And then we really want to be on that defensive side. So every company we're looking at, we're happy to stay on the defensive side rather than go for the pro-cyclical approach now. But again, we can flip quite quickly, but just the opportunity set at the moment is very much on that defensive, cheap valuations for us.
Matt, I just want to ask you, told us a story a couple of weeks back about trading in CBA. I was just hoping you could share with the audience. I think it highlights some of the challenges in our public markets at the moment. So can you share that story? Yeah,
I mean, CBA is nuts. Like, you look at the price action daily, you can almost chart it. It's like a 45-degree angle. So what happens is it generally opens, and then from around 10:30, 11 o'clock, it just goes on this 45-degree up for the whole day. And then on the match, about 30% of the volume gets traded in the match, around 35, sometimes up to 40, and the share price jumps about 1 billion, 1.5 billion in market cap, which is bigger than like the bottom 25 of the ASX 200. There is this incredible amount of money. It's either super funds or passive money buying on close, and I've never seen anything like this before. It's amazing. You can pretty well put your watch to it and time it and watch it happen every day. And then like we started selling in the close and then buying in the open, just trade around $20 million, $30 million of CBA, and you can generally make a couple $100,000 a day by doing that. Obviously, it will come a time where that ends, but it's
today.
Yeah. It still works to this day, so try it.
That's fascinating stuff. Fascinating stuff. All right, we'll keep it moving. The next seismic shift we'll talk about is ageing populations can provide pitfalls and possibilities. So the pitfalls include declining productivity and increased stress on the public purse. The possibilities, of course, are the goods and services that can be sold to what is obviously a very wealthy cohort. Surgeon, I'll come to you. The boomers enjoyed the biggest era of wealth creation in human history. That is going to be transferred over coming decades. I know this is an area that you're interested in. What opportunities will it create?
Yeah, look, in many respects, we've built our business around the trend. So, we're investing in private businesses across Australia and New Zealand, as I mentioned earlier. The vast majority of those businesses are founder or first-generation family-owned businesses. So 25 investments over the last 7 or 8 years, 20 of those have been partnerships with founders, owners, where for various reasons, but age sort of being a key driver in estate planning and family planning, have triggered these individuals to look at partners for businesses that are performing phenomenally well, have got great future potential as well. And so really it's this generational transition that's playing out. And so from our perspective, it's driven a huge amount of opportunity, and we just see that trend accelerating. I think various stats out there, I think PwC say there's about $4 trillion that's going to transition over the next 5 to 10 years. We think it's about 5,000, maybe even 7,000 businesses based on various data. And so for us, it's unlocking a great flow of opportunities and investable opportunities, high quality assets, which is really exciting from a 5V perspective.
Can you give us an example, Surgeon, of one of those businesses?
Yeah, absolutely. I mean, most people in the room would probably be familiar with Zenith. We were invested in Zenith a number of years ago now. We partnered with David Wright, who again, you'd probably have some familiarity with. It's one of the two, leading ratings or funds ratings and research businesses in the country. A very long track record of success, highly credible, and a really core part of a very large ecosystem which we all participate in some way. And really the trigger point there was that there were 4 partners in the business. 2 of those partners, for a couple of sort of different personal reasons, wanted to step away. And it created a great opportunity for us to partner with David and Ben and push the growth in that business over a number of years. And so we were invested for about 2.5 years. We made a couple of acquisitions. Our view was that we wanted to expand the service offering from a funds focus to touch on superannuation. So the acquisition of Chant West was one step in that direction, and a couple of other insurance-related acquisitions. And as it happened, we knocked on the door of a business called FE Fund Info, which again you might have some familiarity with, looking to bring in their data business into Zenith. And they came back to us and said, well, we're not going to sell you our business, but we'd quite like to invest in yours. And that ended up happening, probably a bit earlier in the journey than what we'd anticipated or planned for. But it enabled us to, lock in a great return for our investors and de-risk our position. It gave David and the management team a new partner with, a broader service offering from an ANZ perspective. And it's allowed that business to go, from strength to strength. But really, the key step in that chain that's ultimately played out was a couple of founders that built a great business and they wanted to step away, and that was the opportunity for us. So we're quite excited by the trend that's playing out.
Andrew, one of the big demands of an ageing population is real estate. How is that cohort impacting your opportunity set?
It's continual. I guess at the end of it, you see it on the residential market. You see it also in healthcare, demand for healthcare-related assets, be it aged care, retirement living, healthcare-related assets and the like. So there's, continued just demand from demographic changes. But the real driver, I guess, from a demographic change is probably not so much the ageing population. For us, it's really the impact as a result of immigration flows. Both in terms of student numbers, but also just net immigration, and seeing, the interstate immigration flows as well having an impact around the country.
Matthew, I'll come to you now. We talked about the challenges of an ageing population, productivity loss, high labour costs. How are you investing given those challenges?
Yeah, I guess productivity, you can look at it 2 ways. You either invest in labour or invest in capital stock, and I'd argue Australia's education system is good and education is fine. So Australia is largely a service-based economy. So it's really hard to get productivity improvement in the service-based economy. Maybe some of this AI stuff which eventually comes through will help on the service front on productivity. But from productivity point, generally lower productivity, the government normally has to step in with fiscal, and then it leads on to higher rates because you've got potential inflationary stagflation type environments. So I'd argue that productivity for us makes the RBA a bit stickier. But the biggest thing with productivity, I think, the negative is government regulation at the moment. I don't want to make it political, but I think every sector has had government intervention in it. So that detracts from business investment. And if you don't have that sound framework, it's really hard to have companies deploying capital and investing for the medium long term. So I think, there's a whole mix of things, but how does it affect us? We're trying to stay away from sectors which will get government intervention, but it's pretty hard, to be honest, like supermarkets, airlines, coal stocks, mining. I mean, they pretty well hit everything. Insurance, they're going to come after next, apparently. So it's really hard from a regulation point of view. I think that's probably the biggest weight on productivity at the moment. We've just got a government that's willing to put the invisible hand across every sector. So we'd like to see that clear.
James, you're Overweight Healthcare at last count. What's the thesis there, and how much does the ageing demographic play into that?
Yeah, we own a spread of devices and then also biotechs that are trying to innovate, medication to solve the big problems of the world. Our biggest most exciting opportunity in healthcare is actually an organ transplant system. So actually the old-fashioned thing of putting an critical organ onto an esky and then shipping it, or trying to get to a hospital bed across the other side of a country typically, is a very old technology. So this has been developed over like 10 to 15 years. It's a huge box that basically tries to simulate the human body for plasma or oxygen, etc., blood, and then give life to organ, and then also have a lot better fail rate or success rate of organ transplant. So that's called Transmedics. It's one of our most exciting. It's just gone through loss to profit now, and with FDA approval. So it's obviously the share price has gone up a lot. But yeah, it's got a huge runway, and as a solution for the world, organs, there are, thousands of organs every year. And yeah, it's just a very innovative solution to a social problem.
Just a reminder, ladies and gentlemen, that we will take some questions at the end of the panel. We're about 10 minutes away from the end, so if you haven't submitted questions already, please make sure to do so. The next topic that we'll come to is the energy transition, and I might push forward through this one because it was the topic that the gents were the least interested in discussing, but I will come to you, Matthew. The resource sector, it's taken a bit of a hit lately. I know you're not overly enamored with the energy transition, but you have been dipping your toe back into the water with some commodities. What are they, and perhaps why aren't you so much interested in the energy transition?
Yeah, so commodity space, it really goes against what I was saying before on the economic slowdown, but the way we look at the world, we look through a lens, the macro environment, the fundamentals, and then positioning. So positioning is really bearish on, I'll talk about the big one in Australian iron ore. Everyone's, China's been dead about 20 times over the last 10 years. Like, it's been the classic trade, China property. You'd argue the transition of the Chinese property sector over the last 3 to 5 years has actually been very successful. You've had massive drawdown in property, and the Chinese economy hasn't blown up yet. There's a lot of structural issues there, don't worry about that. But commodities, for us, positioning is negative, very negative. We don't have the data yet to really wind the trade to an overweight, but we have been buying some of the miners just based on positioning. And then we look at the forward indicators in China, which is the total social financing and the local government bond issuance. And in May and June of this year, they were huge. So that generally leads activity. So the Q4 potentially looks quite good. So that may flow to the hard data in Q4. The hard data will be printed, then the capital will flow to that trade. So we've got that trade on, we're increasing it. So BHPs and the Rios of the world, and Fortescue. But we have got our finger on the exit button, because if we do get this slowdown, those stocks will get hit very, very hard as well, even though positioning is very bearish. But it's a tactical trade for us. We see going to Q4, we don't have enough data to really go overweight yet, but it's building. So it's just one we've got our eye on at the moment. And energy transition, it's really hard on the ASX how to play it for us, so we don't spend a lot of time. Also, we look at the LNG, gas was, the saviour, then it was like, it's as bad as coal, and now gas is being thought of as a potential transition, which we do need gas, so we do look at it mainly on the gas side, but other than that, we don't really have huge amounts how to play on the ASX.
James, very quickly, you're underweight materials and energy as well. Again, not particularly enamored with the energy transition, it seems.
Yes.
Why is that?
There's just there's not a lot of options in Australian market, and globally, obviously went through a huge strong cycle, has now come down, and the expectations of the transition, I think, are being pushed out a lot. And with inflation, the pressures on governments everywhere, societies, companies, it's a lot harder than people thought. I think people want it to happen, but it's just a lot more expensive and a lot more challenging. So the way we actually play it is through Energy Tech Company, which is actually an LNG train technology, which actually has the IP for the membrane that goes within LNG trains, or within LNG, tanks. So that's a company, Gas Transport, which is quite innovative. We've owned SolarEdge and other things like that, which are solar panels or solar panel switches or solar panel optimizers, which are quite another way to play that technology space through energy transition. Or the services companies that are the consultants for the energy transition as well. So they're the way we've played it, but it has been, I think, a very challenging 3-year cycle of kind of, very warm to very very strong markets, and now it's sort of reality sort of bites of that whole sort of universe has been pretty tough.
We'll keep moving. We'll get to the last seismic shift. It is digital innovation. It was the most popular in the early poll, and for all the problems that we face in the world, technology and digital innovation have the potential to solve a lot of them. James, I want to come to you again because I know this is an area that you're overweight significantly. Mm-hmm. What are you liking about tech and digital innovation in particular right now?
So look, it's very interesting. It's the number one thing up there. For us, it's probably about half our fund is actually tech. So 25% is actually tech, which is software and software-related businesses. If you look at consumer tech, healthcare tech, industrial tech, if you add them all up, it's half the fund. So we know Australia, we know REA, car sales, all of those, Seek, for example, they've created a lot of change for our country, and they've been huge share price performers over that period. Pro Medicus locally has been huge. WiseTech has been huge. Those opportunities exist in the global marketplace as well. So yeah, as I mentioned, software, industrial tech, ed tech, consumer tech. So when you use the word tech, it is like a way for me. It has been a facilitator of the way of surviving this environment, which is high inflation, high labour, high cost. And for me, inflation and all of those negative cost barriers and cost challenges, technology really is a way to solve that for the whole world, where as in individuals, families, companies and governments. And that's why half of our funding global is basically tech related, which gives us productivity right across that sort of social spectrum.
James, you operate in the mid-cap space, so outside of the remit of the Magnificent Seven. Mm-hmm. Can you share a couple of companies that you really like right now?
I'll mention Transmedics, Apollo, Ares. They're quite of our big ones. Other ones are things like Granger and Amatec. They're just regular, sort of some of those in-betweeners, industrial companies that are just very steady growers. So the whole universe is really tech, consumer, financials and industrials. For us, there's huge opportunities there. So there's a whole range of opportunities in that universe. But those four sectors are pretty much where we see really strong earnings growth, very nice market structures, high quality businesses. We use the words VSC, so high viability, high sustainability, high credibility, and that's what we find where the global future leaders are.
Surgeon, I just wanted to get your take on the use of tech in private markets and the opportunities that you are seeing. So it seems in the public space that it's a bit of an arms race. There's people spending a lot of money, not necessarily dropping down to the bottom line just yet, although James would probably argue with that. But what's it like in the private market space and the adoption of tech there?
Look, I don't think it's fundamentally different. I mean, obviously it's a theme that's on everyone's minds, whether you're in an industrials business or a finance business or a technology business. We're very aware of the opportunity, but also the potential disruption, and so when we think about how do we invest in that space? We don't have the ability to invest in $70 billion market cap businesses. And so for us, that means we're looking at businesses that are supporting the whole AI transition. We're invested in a business in Melbourne called the Mantle Group. It employs about 800, software engineers across Australia. That's helping various companies, whether it's, CBA was in the news this morning with plans around AI adoption and digitization and so on. And so we're looking at various industries that are supporting that transition. From a practical perspective, we're using technology and maybe AI to focus in on that across the portfolio. But I'd say we're doing that in a very practical sense. Kind of think about Horizon 1, Horizon 2, Horizon 3 conversations. For us at the moment, it's still very much Horizon 1, right? And I'd say that most companies are not yet ready to adopt AI because the data sets they have they're not clean, they're not robust enough, they don't maybe have data that's required. And so, we're investing a lot within the portfolio companies that we're invested in to create the right data lakes, to cleanse that information and be able to overlay tools that are maybe not overly exciting, but very practical, So, for example, 4Cabling is a Sydney-based business here that's participating in that transition from a digitization perspective. We run a number of tools over the customer base. There's 10 or 15,000 customers in that data set, and getting to the long tail is incredibly hard for an individual. But running a couple of AI tools, that means that we've been able to uplift the sales in the long tail by about 150% over a number of months. And so these aren't things that are fundamentally transforming or replacing people or removing call center employees in our case, but it's leveraging whatever data we have in the business and trying to drive some very immediate improvements. And so we see a lot of opportunity, and also we're very alive to all the potential disruption that comes with it as well.
Matthew, I want to bring it home to Australia. How are you seeing digital innovation impact Australian companies, and can you give an example or two of companies that are doing it well?
Yeah.
It's very early, so a lot of money is being spent. The comments I make, I very much agree. Like the data is, I didn't realise how important the good companies with good data are going to win. I thought it would be like the great levelling event where everyone would be equal, but it's really good companies with the good data are going to have, you know, that head start, and they're going to win. But what we're seeing for us is really going to be around labour, replacing labour. So, you know, the really labour-heavy companies, like we talked about Telstra before, they've already gone on a huge round of labour cuts. Banks, you know, huge labour expense. So the ones we're looking at to have the most immediate impact is the people that can flex on the labour force. So it's really the Telstras and the major banks for us. They're going to be the real beneficiaries early. And then obviously the next iteration will be how we interact with AI, so software and apps, which haven't been even developed yet. They'll be the new frontier of where, you know, where they try to incorporate into our day-to-day lives. So there's a whole new companies we've never heard of are going to pop up over the next 10 years. So it's going to be really exciting on that front too.
Fantastic. That is the end of official proceedings. I'll now hand over to some audience questions. If we can get some up on screen. All right, first one from Richard. With all the reported crisis, housing, rental, climate, cost of living, etc., are we likely to see a consumer crisis over the coming decade? I might come to you, James, for that one.
For me, look, in terms of Aussie consumer, I think, look, if you're going to have a crisis, I think you would have had it now. I mean, Matt referred to it may be coming. It's still, people have been waiting for it to come. I do think that there's a consumer challenge. I mean, I was very surprised as a recent owner in Collins Foods that KFC takeaway was actually going, you know, slowing down in sales. So people are really, really pulling back. But you don't see, you know, bad debts for the banks. So there's a lot going on in people's heads and people's lives to try to manage costs. So I don't think that there actually will be a consumer crisis in the Australian market, which as an Aussie, I'm pretty happy about. I think it would be a pretty ugly outcome because the knock-on effect of banks and banks having, over $1 trillion of housing collateral on their balance sheets is just massive for our country. And if you look at what happened in the GFC, the RBA stepped in and gave them support. So I think, yeah, the consumer/housing crisis would be very, very dramatic for our country, and I don't think it will happen, which I'm happy with. But I do think a lot is going on in people's heads right now to cover costs, to get down costs.
Andrew, one for you. With the rise of private credit, how much are you factoring in for defaults, and what impact do you think that will have? It's always fun when the question moves as I'm reading it.
Look, at the end of it, you can look back on historical data, APS 330 disclosures from the banks. The losses in Australia, corporate credit peaked for the banks at 0.67 or 1% soon after the GFC. So it's a market where loss rates have always been traditionally very low. I think if you look at Judo's last report, I think they quoted something like 13 customers for a negligible amount of losses that they've disclosed. Interesting, when I was thinking about that prior question, you know, we also have quite a number of investments in consumer-related finance companies. And our experience is actually the default and arrears rates have actually reduced since we've been involved with these. So at the end of it, it's around how you manage credit, how you stay on top of the risk, and avoid taking risk in a inappropriate sort of way. And I guess the benefit I guess that we have at Metrics is that I guess we've had decades of experience lending money through different cycles. We've gone through ups and downs, and the thing that always you keep in the back of your mind, there's a lot of levers, and there's a lot of things where you're not the sole provider of capital. What we might think is an inappropriate risk, another lender might think is a great deal, and happily refinance us out. So at the end of it, how people respond to different market conditions, the way in which they finance their business, the way in which they might attract capital varies. And often what people fail to understand is that the party that really wears that risk is the existing shareholders. So you go through economic deterioration or events, go to the GFC, go to the pandemic. what did a lot of large companies do? They undertook deeply dilutive equity raisings for no purpose other than just to restore their balance sheet and pay down debt. They withheld paying out dividends, not to reward shareholders, but to make sure they had liquidity and cash available to pay down debt. Australian corporate insolvency laws are very protective of the interests of a creditor. And so again, this idea that private credit or lending is supposedly, some unacceptable risk profile for an investor portfolio, I think misses the point. We're quite happy to, have a situation where people clearly, market perception is that they're manipulating the buy, sell and CBA, but, the media presents this terrible image around valuation and inappropriate governance standards within private markets. There's a lot to be sort of said. At the end of it, track record, history of performance speaks for volumes in terms of what's been delivered for investors. Yet in public markets, people are happy to have 3%, 4% volatility in a day, and they don't bat an eyelid. But supposedly in private markets, everything is a disaster. And so I just sort of look at it and sort of say, well, at the end of it, we've been doing this for over a decade. Every single one of our funds has exceeded its minimum target returns. Every single one of our funds we've delivered in terms of risk profile and managed that appropriately. I think we've delivered a great source of capital to a whole range of companies to support their growth activities and genuinely contributed to the success of the economy. And so I certainly look at it and say, in Australia, we don't have the loss rates, we don't have the excesses. If I look across our portfolio, there's no evidence of any sort of excess in any one industry or sector that would sort of suggest to me that we're facing into certain loss. The economy is clearly slowing, and our role as a lender is to make sure that we manage that risk through the cycle and take whatever action is necessary to protect our investors' capital.
One more, James. I'll pose this one to you because you're in global markets. The upcoming US election, is it going to have any impact at all? And who do you want to win? Loaded question.
Yeah. I'm going to pass. Maybe go to the next question. Look, the US politics generally hasn't had a massive impact on our investment style over the last 5-6 years. Typically, there's very pointy bits of regulation, whether it's energy or healthcare. They're typically the two that are very sensitive to regulation change. Rebates in healthcare and regulation in energy. So they're the two that we're looking at. We don't have massive exposures in those two universes. So for us, it's less of an impact. I'll stay away from the politics.
Fair enough. That is time. Ladies and gentlemen, please put your hands together for Matthew, Surgeon, James and Andrew.
Thank you.